Welcome to the Deep Dive. We're here to turn a dense earnings call into actionable, clear intelligence.
And today, we're dissecting the Q4 2025 results from Mission Produce, ticker AVO.
Right. And this is a necessary deep dive because this call presented a classic agricultural dilemma.
It really did. How do you stay profitable when the price of your main product is just, plunging?
Exactly. So our mission here is to understand how Mission Produce didn't just tread water, but actually delivered a record Q4 in terms of adjusted EBITDA.
We're going to isolate the operational leverage that let them do that. We'll analyze the big CEO transition and, maybe most importantly, quantify what management means by this long-awaited shift to accelerated free cash flow.
Okay, let's unpack the numbers, because there was a fascinating divergence right out of the gate.
A huge one.
On the headline figures, you have this clear operational success story. The non-GAAP adjusted EPS came in at 31 cents a share.
Which just blew past the consensus estimate of about 19.5 cents. I mean, that's a 59% beat, a decisive beat.
That's the number that really drove the stock's reaction after the call.
Absolutely.
Yeah.
But we have to look at the other side of the coin.
The GAAP EPS.
Right. The generally accepted accounting principle number, that was 22 cents.
And that was actually a slight miss against the 23-cent consensus?
It was.
So wait, if GAAP missed, doesn't that suggest the underlying structure isn't as clean as the adjusted numbers make it sound?
Right.
What were they adjusting for, and why should we prioritize that non-GAAP number?
That's a crucial question. In this context, the market focused on non-GAAP because it strips out things like non-recurring items, one-time costs, things that can muddy the waters.
Okay.
And in a super volatile commodity environment like this one, the adjusted EPS, it shows you the true operational performance. How well did they manage the fruit, the logistics, the costs?
So a 59% beat there told the market that the core business is highly disciplined despite the chaos.
Exactly. They beat on operations.
Got it. And revenue, they came in at $319 million, which easily beat the expected $293.9 million.
Yeah, that's an 8.5% beat on the top line.
But, and this is the big but, despite those positive beats, total reported revenue was still down 10% year over year.
And that right there, that is the crux of the entire Q4 story.
Right.
Revenue down 10%, yet they simultaneously generated a record Q4 adjusted EBITDA of $41.4 million, which was up 12% year over year.
That's financial acrobatics.
It is. It just proves that the surge in volume combined with superb margin management fully and successfully offset that dramatic price decline.
Let's dive straight into that dynamic then, because the pressure from the commodity down cycle sounds brutal. What was the exact pricing headwind they were navigating?
Oh, it was a massive correction. The average selling price per pound of avocado fell sharply. We're talking down 27% year over year.
27%. Wow.
It settled at $1.39 per pound. And management was very clear this pressure came from oversupply.
From where?
Well, you had increased availability from Mexico, their dominant source, and that was coupled with way higher production volumes coming out of Peru.
So when both major taps are flowing, prices just sink fast.
Exactly. A 27% price drop is an existential threat for most distributors.
But Mission Produce's volume-centric model held firm. It sounds like they were just taking volume off the market at a record pace.
Absolutely. The strategy paid off. Volume sold was up an incredibly robust 13% year over year, hitting 181.5 million pounds.
So the theory is simple. If you make less per pound, you have to sell dramatically more pounds.
And you have to do it more efficiently than anybody else. That's what allowed their gross margin to actually expand by 180 basis points.
Wait a minute. That margin expansion is the most counterintuitive part of quarter.
It is.
How do you expand your gross margin by that much? I mean, you're increasing profitability when your revenue per unit is down 27%. That defies normal business logic.
Well, it doesn't defy the logic of a vertically integrated, globally flexible distributor, which is what Mission Produce is becoming.
Okay, explain that.
When prices are high, any distributor can make money. When prices are low, the advantage goes to the company with the most sourcing flexibility and the lowest internal cost base.
So Mission used its global network to redirect fruit to regions where they could get higher margins, like Europe and Asia.
Precisely. And they simultaneously leaned really heavily on low-cost fruit coming from their own land in Peru.
So the efficiency thesis is validated. Let's break that down by segment, starting with marketing and distribution, or M&D.
Right, the sales engine.
Yeah.
M&D net sales dropped 15% year over year because of those prices. That's just a pure mass problem.
But the profit.
Segment adjusted EBITDA increased 11% to $28.3 million. This segment proved they could manage per unit costs and volumes successfully, even against really high comps from last year.
And that global network push seems to be accelerating. Their international traction is incredibly strong.
It is. European volume grew 40%, and UK revenue specifically was up over 60%.
They're clearly using that stable, cheaper fruit to build long-term programs with major international retailers.
Exactly. And that international push brings us directly to the reason for their cost control: international farming. This segment was a powerful driver for the entire quarter.
How much did it contribute?
Total segment and sales were up a staggering 97%.
97.
And segment adjusted EBITDA more than tripled to $8.4 million.
And what drove that?
It was driven almost entirely by the recovery of their own Peruvian orchards. You might remember those orchards got hit by weather in previous years. Well, this quarter, they rebounded spectacularly. They more than doubled their exportable avocado production from 43 million pounds last year to 105 million pounds now.
That recovery really highlights the immediate massive leverage of vertical integration.
It does.
When you own the farm, the fruit comes in at a lower internal cost, shielding you from the worst of the market volatility. That's a powerful defense in a low-price environment.
It lets them absorb that 27% market price drop and still hit their profit targets, because their own fruit is just cheaper than buying it on the open market.
It must give them consistency, too.
Vital for securing those large long-term contracts in growing markets like Europe.
Okay, before we move on to strategy, we have to touch on the diversification play. They're expanding into blueberries and mangoes.
Right. On blueberries, they now have 700 hectares in Peru, and sales were up 16%.
But there was a headwind there, right?
It's important to note the short-term profitability headwind. Yeah. While sales grew, the segment's profitability actually declined.
Is that a failure?
Not necessarily. It's more of a necessary cost of growth. They've brought new acreage online, and younger plants just have lower yields. That drives up the unit cost until the plants mature.
So it's a predictable, temporary pain point they're accepting for future gain.
A short-term investment for a long-term agricultural payoff, exactly. And the mango category continues to mirror that early avocado playbook. Just focus on consumer awareness.
And their market share in mangoes is growing, up 150 basis points to 5.2%.
Yep, and they're targeting consumer engagement. Household penetration for mangoes is approaching 40% now, up from 35% 3 years ago.
They are applying the distribution muscle they honed with avocados to build a whole new domestic market.
You got it.
That strategic push really sets the stage for the major news outside the numbers. The leadership succession plan.
It's a significant transition, but they've structured it for stability. The founder and CEO, Steve Barnard, is moving to executive chairman.
And the current president and COO, John Pawlowski, will officially step into the CEO role in April 2026.
That long ramp-up suggests a very careful, deliberate handoff.
The message from management seems to be less of a revolution and more of an acceleration. The foundation's strong, now it's about growth, both organic and through M&A.
And that brings us to the financial phase change they've been promising, the free cash flow inflection point. This is maybe the most critical forward indicator for investors.
A big one.
They are formally announcing that they are exiting their heavy infrastructure building capital investment cycle.
What does that look like in hard numbers? How much money are we talking about flowing back to the balance sheet?
We're seeing a significant step down in capital expenditures, or capex. They spent $51.4 million in fiscal 2025. For fiscal 2026, capex is expected to fall to roughly $40 million.
So that's an $11.4 million reduction. That's a direct catalyst for accelerated free cash flow.
Right. The massive infrastructure projects, the packing facilities, the new groves, they're now substantially complete.
And they gave us some granular color on that new $40 million capex figure, which I appreciate.
They did, which is very helpful for modeling. Management says that $40 million is almost perfectly split. About $20 million for maintenance capex.
Just keeping the lights on.
Right, keeping the machinery running and trees healthy. And the other $20 million is still earmarked for pure growth.
Which shows they can generate significant cash while still funding future expansion just without that huge burden of the last few years.
This flexibility, paired with a healthy balance sheet, leverage is strong, well below one-time adjusted EBITDA. It gives them a lot of options.
It certainly does. They can prioritize disciplined growth, maybe M&A, but they also have the muscle for share buybacks, which they did this year.
That's a huge advantage as they head into what looks like a sustained low-price cycle.
Speaking of that cycle, let's look at the immediate guidance for Q1 FY26. Sounds like the pricing pressure continues.
It does. For Q1, industry volumes are expected to increase by about 10% year over year. Again, driven by a larger Mexican crop.
Which means pricing is expected to be about 25% lower year over year.
Compared to the high average of $1.75 per pound they saw in Q1 of FY25. Yeah. So management is forecasting some sequential margin compression, but they stress this is consistent with typical seasonality.
That level of expected price pain in Q1 is tough, but they frame the lower pricing as a strategic advantage long term.
For household penetration specifically.
Right.
They see this environment as a critical tailwind. Current household penetration for avocados in the U.S. is about 70%. Their goal is to push that to 75% over the next 2 to 3 years.
And they have historical data to back this up.
They do. When prices are lower, consumers try the product. Consumption jumps. And crucially, those consumers tend to stick around even when prices inevitably rise later. They're sacrificing some near-term revenue to acquire lifelong customers.
So what does this all mean for you, the investor, looking at the stock? AVO has significantly outperformed its sector ETF over the last year, and the market responded constructively to these results.
Yeah, the post-call tone really validates this central theme. This is a story of impeccable execution overriding commodity price noise. Investors are rewarding the ability to maintain and even expand margins while aggressively driving volume.
It validates the entire global network investment and the recovery in Peru.
And that combination, the successful defense of profitability and the clear pathway to higher free cash flow, provides a rock-solid foundation for the incoming CEO.
I think we've fully set the stage for our final segment.
Let's talk about the setup.
This is not financial advice.
So we've established AVO is in a major transformation.
Right. It's shifting from a high capex, infrastructure building growth play to a business dedicated to generating free cash flow, all while the commodity price is in a multi-year trough.
This creates a fascinating disconnect where operational performance and financial realization are decoupling from the price of the actual fruit.
Exactly. The operational advantage is finally being realized financially because of that capex step down.
Okay.
So here is our outrageous but plausible trade idea for this earnings call. The FSRUF inflection hedge.
I like it.
The thesis is simple, betting that management turns that $11.4 million in reduced capex directly into shareholder value, regardless of the price of an avocado in Q1.
Walk us through the structure.
Action 1, go long AVO stock. You are specifically betting on that successful CEO transition and the immediate tangible boost to free cash flow. You believe the efficiency they showed in Q4 is sustainable.
And the plausible hedge. Because we know Q1 pricing is expected to drop 25%. That's a huge headwind for the whole sector.
The hedge is crucial. You simultaneously initiate a short position on a less vertically integrated pure-play competitor, one that lacks AVO's global network or its owned, cost-controlled Peruvian farms.
Or if a direct short isn't feasible.
You could short a deep out-of-the-money call option on general agricultural commodity futures related to avocados or a viable proxy.
So the rationale is you're capitalizing on AVO's superior operational structure. You're betting their network lets them steal market share and sustain FCF growth, while the commodity hedge protects you against the indiscriminate sector-wide drag from that price collapse.
It's a bet on management efficiency, not the commodity cycle itself.
That's the FCF inflection hedge. Definitely something to research closely.
To recap our deep dive, Mission Produce delivered a demonstrably strong operational quarter, validating their volume-centric model in a challenging price environment.
The key takeaways are that successful margin expansion through cost control, the critical recovery of their Peruvian production, and the strategic importance of the leadership transition paired with the definitive end of that heavy capital investment cycle.
That sets up a great final thought for you to chew on. Management explicitly mentioned exploring M&A now that the balance sheet is strong and excess cash is returning. So if you are the incoming CEO, What adjacent fruit categories or geographical regions would provide the most immediate and synergistic leverage to their existing massive global distribution platform?
Something to mull over until our next deep dive. Until then, stay informed.
And keep digging.